Good morning. You're watching The Market right here on 18 now with me, Aisha Faridi, Avant Dabash, Nikunj Dalmia in the studios. And for the markets, it seems a pretty picture, that is. While the SGX Nifty this morning may be indicating a bit of a tempered start. Tempered actually is how we were yesterday as well, to be fair. So consolidated a little bit around that 18,600 print. Still within kissing distance of that all-time peak, and I say that because we're only around 2% away from that mark. So it's really a matter of time that we would actually reach that level. Having said that, yesterday we did see some resistance around that 18,600 level. IT, PSU banks, FMCG, they closed in the red, but it was autos which actually were the ones which were leading the charge. And within the broader markets, it was defense stocks which were abuzz on strong order intake as well. And some days of consolidation is really not bad. It's only healthy.
You know, in last 6 days, and let's look at the 6-day graph here. We'll go back to that graph. Markets have simply marked time. Now, you may say it's a range of about 200 points. In last 6 days, what we've done is that we've just moved in a 600-point range. So it's like saying that the bulls are refueling the tank before they take the giant leap forward. What makes me confident and perhaps gives me optimism, and the reason why I have a constructive view is purely not because of FI liquidity. I think that turn in liquidity is something which markets are already discounting. What gives me reasonable amount of confidence and also a positive view is because globally things are looking strong. Apple stock last evening hit a new high. Nasdaq has made a roaring comeback. Nvidia is now $1 trillion company. So globally also there is a moment of risk on, which clearly will help the markets on the margin. For Indian markets to stay high and make new highs, I think you need a lot of global support. You cannot do that in isolation. And I think that frankly is a new dimension which we must explore. Up until now in the month of April and May, the theme was FIs are back. India is the only story in the town, and India will get disproportionate amount of flows because money is rotating back from China. But I guess there is a global element to it, which is that globally things are looking up, and maybe selectively, maybe it's not S&P, maybe it is tech, maybe it is big five, but that there is an element of risk on, especially in equities and tech stocks, which I think will help the stocks on the margin.
Okay, yes, indeed, need that little bit of a global support as well. That is critical for our markets to move higher. But let's move on to a sector then and discuss the prospects of the Indian defense sector. And it's critical because India and the United States have just recently concluded a roadmap for the defense industry cooperation for the next few years. In fact, the two countries have said that there's going to be a landmark move that will help to bolster India's manufacturing ambitions. You will have the US as well that will deepen their ties with India. They're talking about stronger military-to-military technology ties, and that is key to counterweight China's dominance in the region. And Nikunj, defense as a space as well, if you take a look at the historical averages and the kind of move that we've seen, it has been in a sweet spot.
I mean, it's in a bull run. Sweet spot is an understatement. Why defense stocks are in a bull run? You must understand first, to take the clock back. What happened immediately after the COVID? The government's whole attempt towards making India Atmanirbhar ties in beautifully with the defense story. India has been one of the largest importer of defense, of defense equipment, plus in terms of the ships and the planes in the world. The entire sector has seen what could be called as a big change, and that's largely centered around the fact that Indian manufacturing in defense has got a leg up after the government's support. PLIs were and import restrictions they came in. This is a sector which up until now was dominated by PSUs, which were not very efficient. But there is a complete change in the way how PSUs are now conducting themselves, how they've adopted to technology, and how the fact that the government new policies are really benefiting some of the defense companies. So I'm not saying anything new. But at the current juncture, we must realize that after this stellar bull run in some of the defense stocks, are they likely to outperform, or they can best be market performers? My sense is that in the near term, defense stocks at best could be market performers. They are unlikely to be market outperformers. Why am I saying that? Because while the nuts and the bolts of the sector has changed, there is a change in the way how the landscape of the defense sector in India will evolve. You must realize that in the defense sector, the order book will always look very bulky at the start of the cycle, but these are long gestation projects. You cannot build a submarine in a quarter, you cannot build an aeroplane in a quarter. It takes 5 to 10 years to actually make a ship and to build a submarine. As a result, some of these companies have got order book which may look very attractive if you are looking at companies purely from the standpoint of order book, and which is what markets have done. But sooner than later, I think markets will realize that some of these order books will take time before they actually kick back into profitability. And these are not like 30% margin businesses. These are 20-25%. These are margins which are less than 20. These are competitive businesses. There's a commodity angle to it. So while you may say that, okay, this space has got a long way to go, but in the near term, I think looking at the valuation, looking at the business cycle, and looking at the construct, and after the recent run-up, my sense is defense stocks now at best could be market performers.
Okay, let's see which way the defense stocks head. For now, at least, they seem to be holding a buzz. But it's actually crude, talking about commodity prices. Saudi Arabia, remember, has raised crude prices. They lifted all July crude prices for Asia after the recent output cut by OPEC+. Aramco has set the Arab Light crude for July at $3 to a barrel for Asia, and they've lifted all July oil prices for US, Europe as well after the output cut. So WTI crude is now currently hovering around those $72 levels. Brent is now quoting around 76, and that I think seems to be the only uncertainty, right? This volatility which comes time and again when it comes to crude prices.
Why is the volatility coming in? It's not largely because the demand has gone higher. It's because you're constraining the supply. Yeah. You're constraining the supply when the OPEC members and the non-OPEC members, they know that the demand is going to be less. And bear in mind that they're cutting oil production at a time when the US driving summer season is about to start. Now, there are 2 points where the oil demand, because of the nature of the nature of the season or cyclicality, they always higher just at the onset of the winter and just at the onset of the summer driving season in US. The fact that they've cut production twice already in this year and crude prices have still not gone anywhere, I think that just tells you that which way directionally the crude demand is headed. I think crude was a worry last year. It was a big concern when crude went closer to $120, $130. But I think that's no longer the challenge now. Demand from China has not been strong. US definitely is slowing down. The energy crisis which had hit the world after the COVID, after the war, I think that clearly is behind us. While we may argue and say that you want to settle at crude ideally should be between 55 to 65, I don't think we are headed there. In terms of in macro, the Reserve Bank of India assumptions, both in terms of what they are assuming for growth, the crude assumption is closer to $90, is closer to $90, and crude is nowhere close to what the Reserve Bank of India assumptions are, which means that really becomes a buffer, and that really is going to be adding back when they are going to be considering the credit policy later this week. So what's happening in the crude market, yes, volatility, yes, news driven, but directionally, the move by the OPEC and the non-OPEC members and the comments which are coming by international experts, they're clearly pointing that the natural direction for crude is headed lower rather than headed up.
Okay, that's the view coming in on the entire commodities basket. But that aside, it was a big day for tech as well, as Apple kicked off its 2023 Worldwide Developers Conference and lots was announced. The new headset, actually, that's the Vision Pro, that was the huge announcement because that has been the first big move since launching the Apple Watch 9 years ago. So it's been described by Tim Cook as spatial computing. It's a three-dimensional camera microphone system. It captures videos, pictures, and you can later view that in 3D. And he did save the best for last, talking about the price point as well. $3,499 is what the Vision Pro will cost once it launches early next year. So those were a lot of the big announcements. Other than that, there was the 15-inch MacBook Air, the MacBook Studio, iOS 17 for the iPhone. So Nikunj, Aisha, what do you guys want to get your hands on from?
I'm happy with my current iPhone.
No Vision Pro for you, Nikunj?
Not yet.
No, I mean, just that I've not explored that whole world of VR. Maybe slightly old school, maybe slightly conservative, but I've not really walked on that whole experience of VR. I know that is something where the natural migration is actually going to happen, but imagine, I mean, the whole VR world is a completely different experience, because the whole VR cycle, I think, had a great start, but then it just slowed down, because I think there were challenges in terms of how much more you can actually develop there. So I'm not really a VR expert. I've not experienced a VR ever, but this is something which that is the natural migration for Apple. I mean, that's what Apple is. I mean, they keep on just innovating. They just keep on migrating from one technology to another technology. They may not be the first one to call the new technology, but the way when they come back with such a ecosystem which they are able to create, it just absolutely puzzles me. I mean, if the pictures are anywhere close to what the real VR experience would be, I mean, even though I've never experienced a VR gadget, I think I look forward to this launch.
Yep, it is pretty cool, and it's a display that shows off the user's eyes to those on the outside world. All right, let's move away from that and focus in on global commentary then. We've got Vinny standing by. She's going to give us a summary of what the top global commentators have been talking about. Hi, Vinny.
Good morning, and we'll start by talking about the issues that are coming in terms of the commercial property exits in the US. And Mohammad El-Arian is actually highlighting that US banks are preparing for the losses and they're rushing out to prepare for those losses, especially coming in for the commercial property exits. Now, furthermore, what he's highlighting is that this is something that one should keep an eye out on. It's a very important development given the size that we're seeing in terms of the outstanding loans, as well as also the maturity structure. There's a higher for longer structure rate which is going on, and the world would be refinancing and may prove challenging for some of them as well. So surely a one to watch out for over there. Lawrence H. Summer furthermore is highlighting in terms of the rate hikes. He said that what he's saying, that the Fed should actually be open to raising the interest rates by 50 basis point if they see the central bank this is in July. If they see the central bank pausing in the rounds of policy tightening this month, then that is something that they should be considering. That's the comment coming in from him as well. And lastly, let's move on to a comment coming in from the IMF Managing Director, that is Kristalina, who's saying that what they're seeing is they do not see a significant slowdown in terms of lending. Yes, there is a slight bit slowdown, but not enough that we could see the Fed stepping back. And what she's stressing on furthermore is that do not forget that that we are warning that we are in an uncertain time, an exceptionally uncertain environment right now, what is going on, and therefore one needs to pay attention to the trends that are shaping up, the changing trends, be agile as well as adjusting themselves to these trends as well.
All right, thanks very much, Vinny, for highlighting all of those details. That's the global commentary. Let's connect with our charters then. Naresh Mirani and Kunal Bothra joining in. And Kunal, given the fact that we have been in this range for the past many days, what's your outlook for today's trading session? Yesterday, we did manage to hold out about above 18,550 as you predicted.
Yeah, so I think, it's a two different set of markets which are going on. On the index front, there's absolutely nothing which is happening. The indices are in a very tight kind of a range, but that would probably be termed as good for the index because, when we are migrating to a higher point or a higher band for the index, you would want that periodic consolidations could probably happen for the index to digest those, those shifts or those migrations. On the other hand, there's a lot more vibrant market across the mid-cap and the small-cap arena because you've seen so many stocks. So I think the number of stocks yesterday which were up 10% plus in the NSE 500 was also an indication that the mid-cap end of the market is a lot more stronger as compared to the large-cap names. And we've seen many of the large-cap names still struggling into finding their ranges for themselves. Large cap names like HDFC Bank, Reliance, they are still quite some distance away from their long-term highs. So I would believe that we could probably get into that continuation phase where the large cap names, the Nifty would probably go into very slow, steady and a gradual uptrend. But the mid-cap end of the market is where one could probably focus into, especially on the momentum stocks and sectors. So the view remains bullish on the index, and possibly if we dip by say another 50 to 100 points on the Nifty say in the next couple of days, that should be taken as a good buying opportunity.
Naresh, hi, morning. Do you also see some resistance after the near about 200-point consolidation, or rather range, that we've been in the last 6 days?
So essentially, the Nifty has been a slow and steady uptrend, given the fact that 40% of the index weights are not really in that momentum phase. So, say on the Nifty at 18,600, the Nifty is 2.5% away from an all-time high. Out of the 8 top constituents, 6 are still far away, not in that range. So, what do we get is, if we do not get leadership in these names, you have a slow and steady uptick coming from the rest of the 60%. So overall, unless we start seeing Reliance or HDFC Twins take even a bounce back from here, we would be going slowly towards 18,800, 18,900. So overall, the view is you want to be buying now closer to 18,400 to 500 zone, and looking at 18,800, 18,900. This is the band which I would be playing with in the index. But at the same time, the broader markets have continued to show resilience. They've continued to go up on a day-on-day basis, getting a little overbought, but the momentum is still strong on the broader markets. So time to be more stock specific rather than index.
Let's be stock specific, Naresh. What's on your list?
So going with the stocks in the large cap space, first is a buy on L&T. The stock has started recovering from that 2200 mark. Yesterday was a good momentum day. Expecting this to make a new 52-week high and an all-time high. And even then, it would be an underperformer to the whole capital goods space, what has happened with the larger names like ABB, Siemens, or even the smaller names in the broader market. But overall, the trend is up. The retest is done of the breakout and now setting up for the next leg of the move. So stop loss at 2200 and a target price of 2500. Second is a buy on IndusInd Bank, which is a multi-year breakout. The stock is finally above the 1250-1300 resistance, which was there for almost 4 to 5 times over the last 2 years. And if we go back to pre-COVID prices, the stock used to be 1250-1300 when the fall started. So finally, there has been a recovery beyond those levels. This indicates a new trend is starting. And this trend implies this could be a leader in the banking space going forward. Stop loss to be placed at 1250 and a short-term target price of 1450.
That's what Naresh is betting on, IndusInd Bank and L&T. Kunal, let's find out what you're looking at, because it's clearly heavyweights.
So yeah, I think I'm betting on the auto pack. So M&M is one of the first pick which I would suggest as a buy. The stock has come back quite roaring into the momentum zone back again after yesterday's price uptake. So would suggest a buy. 1440 could be a near-term target. That should probably land the stock back towards the life high levels, and stop loss for this trade 1370. And BHL is one of the stocks which I've been recommending over the last 2 days. A very interesting chart. The stock has confirmed a swing breakout after a very strong month of April. The stock went into a sideways range for the entire month of May, and it's now making a comeback again after bouncing off from the levels of 80. So keeping 82 as a trailing stop loss, suggesting a buy with targets of 90.
Okay, let's move on and let's look ahead. Is Sensex at 1 lakh a possibility soon? That is the question that we've been posing to the biggest market veterans, and they clearly believe so. Here's a word coming in from Chris Wood, Shankar Sharma, Nilesh Shah, as well as Mark Mobius.
That to me is very reasonable. Yeah, I would be disappointed if the Sensex had not touched 100,000 5 years from now.
I'm absolutely certain it will reach 1 lakh. Now, whether it happens in 4 years or 6 years, frankly, is really a meaningless debate. But looking at the nominal GDP growth rate, which we are looking, you can safely say we can grow between, say, 12 and 14%, maybe 10 and 14%. You will approximate that number, and if you compound it at that, so in 4 years, roughly from 60,000, you add another, say, it comes to approximately 1 lakh in 4 years. I mean, it's not a reach to see 1 lakh, just at the simple compounding of the nominal GDP rate. I think it's a given, 100%.
Market को predict करने की कोशिश मत करो. More often than not, you will be wrong. But today, is 1 lakh Sensex looking unimaginable? Answer is no. And my request to this audience will be, just don't think about 1 lakh Sensex. Beyond that also there is a much, much longer journey.
Generally speaking, if a country is growing at 7%, you can expect companies, reasonably good companies, to be growing at 14%, double the growth rate of the country. So it's very possible that you can get this incredible growth in the size of the market and the actual investments in the market, no question.
Bolinchka joined us now, head of research with Ventura Securities. Let's understand from him that the fact that the Adani Group has repaid a lot of debt, what it means. Vineet, can you break last evening's news for us, that what it means for Adani Group of companies?
Actually, it's nothing new. They've already done that before, much before. And it's just a new press release. Basically, what it signifies to the market is that, the group is financially very sound. It's not unduly leveraged. And it's got its finances in control despite the fact that, they have a very, very strong, ambitious plans for growth, for which requires a lot of capital. And another very important thing is that their cash flows are very strong. So despite everything that happens that happened post Hindenburg, the company has been able to keep itself afloat and is managing its capital very in a disciplined manner. So we believe that will send very strong signals to the market today, and we could expect some further action to happen in the stock.
Already seen a nice recovery play out in the entire Adani group of names, but you think this move is going to sort of further, be looked at as an event to win back investor trust, like you said, clearly, which was shaken up after the Hindenburg episode back in February?
Yeah, see, the group was suffering from a lot of questions around its opacity, because the market couldn't fathom the sharp rise that took place in the Adani stocks and the way he was, acquiring companies one after the other. And people were questioning from where the money was coming from and wasn't he getting over-leveraged. But the fact that, just in a short span of 3 to 6 months, if he's able to, consolidate his finances, prepay debt, and mind you, the debt prepayment comes very attractive terms because a lot of the Adani debt which was listed overseas, that paper was in substantial discount. So all the payments which are coming up for payment would have been very quickly cleared. And we should also not forget one more thing, that there's a lot of Adani debt which is coming up for refinance in 24 and 25. So that is also creating a little bit of a positive momentum for the stock going ahead.
Now, the fact that the Adani Group yesterday in a press release, they've really indicated that how the leverage and how the debt repayment has moved. My next point is that when is the next big repayment due, and should markets be worried about it?
See, as I said that in FY24 and 25, there will be repayments coming up, especially in the case of Adani Green, where there's a lot of paper which is maturing. So investors should not be very unduly worried about that, because that will be a kind of a regular event happening, because old debt which was short-term in nature will now be replaced with long-term paper. And we believe that this refinancing activity would not be much of a problem for the company, because they have got they've got 200 plus international investors who have invested in the debt, and over the last 6 months, extreme scrutiny has gone into the operations of the company, and the fact that nothing much has come out of it indicates that it's a very, very strong enterprise. And in my opinion, refinancing of the debt would not be a problem.
Question is that I remember reading, I think, on a forum that the Adani Group has decided to indefinitely delay their green hydrogen plan. Now, that was the big assumption for Adani Enterprises for a big, business trigger, that they will venture into the green hydrogen space, and that, in a sense, would be the fillip for FY26 onwards. What changes in terms of the growth assumptions because of this change?
So since the clean sheet that they've got from the committee that was set up, I believe that their hydrogen plans are back on track, except for the fact that they could get delayed by 1 year. So nothing really changes in terms of the aspirations and the growth trajectory of the hydrogen vertical. But what really happens is that, in my opinion, Adani will not get any more investments from Total, which was about $5 to $6 billion, which was going to come in as equity capital. But what now will transpire is that Adani Enterprises, through its own internal accruals, will be funding that part of the business. So to that extent, there would be a little bit pressure on their funding plans, right? But they have already said that they are going to go slow on other investment opportunities which are of lesser, visibility. So they are consolidating finance in that manner. And this $5 to $6 extra billion which they will require, they would be need to raise it over the next 5 to 7 years. So there is no immediate threat to the green hydrogen vertical plans.
All right, Vineet, really appreciate your time. Thank you for joining us. All right, Sharad is ready and he's going to summarize that what really was the big communication from the management of Delivery as they just have concluded their analyst day successfully.
Yes, we had the analyst meet at Delivery and they have stated that they would be actually matching the prices for their two business segments, and this includes the PTL business as well as the express business, and they have stated that they won't be cutting prices over the next 9 to 12 months. And there was a bullish commentary coming in that even without cutting the prices, they're expecting that they would be actually seeing a market share improvement going ahead. Apart from this also, they have stated that captive players actually who are actually opening their logistics for the third party were unlikely a threat to the Delivery, and this comes in the recent news as Meesho has also come onto the aggregating platform in delivering in the logistics space. Now the management is believing that the impact of ONDC, that will also be very strong, especially the fundamentally shift moving from the intermediary places to the aggregators. But now looking at the business itself, there are barriers which are entries are low, but the barriers to scale, that is something to watch out for. And for the express parcel business, they have given an adjusted EBITDA margin guidance of roughly 13 to 14%, while the ROC numbers is expected to come between 30 to 40%. Now looking at the stock, mixed set of quarterly numbers came for the March quarter, but do remember this is the first time the EBITDA margin was positive since listing for the company, and the 12-month target price as per the Bloomberg is coming in at 415 rupees per share, which indicates roughly a 17% return potential. However, the stock has been range bound since October itself.
Right. We'll leave it at that, Shara. Thanks much for highlighting what transpired at Delivery's Analyst Day. But hear it out from Manu Talwar, the CEO at Mrs. Bector's Food Specialities, which is targeting a 14% margin over the next few quarters. He also told us when we last chatted with him that the company will continue to focus equally on margins as well as revenue growth.
We are focusing on premiumization. We are a value on a premium company, right? And our premiumization in the last quarter and the previous quarters have improved. So we continue to focus on premiumization in our company. In terms of price and volume growth, so our growth was primarily volume-led. So even in the previous quarter and this quarter, the growth has been largely volume-led. So what we kind of shared with the investor in the previous quarter also, that we target to deliver around 14% EBITDA for the next few quarters on a consistent basis, and then we do our journey of moving from 14 upwards to 15% EBITDA. So as of now, we maintain the same. So as we are also investing in the marketing and selling and distribution, so we would stick around maintaining our EBITDA around 14%, and then over the next few quarters, and then do a journey of moving from 14 to 15%. As we have always said that we as a company are equally focused on revenue and margin. So we're very clearly a margin cautious company along with driving our revenue growth.
Okay, let's understand this better. Put it into context. Where does Mrs. Bector's Food stand in comparison to some of the other FMCG heavyweights? What is the outlook when it comes to the organized Indian biscuit market share? We've got Vinny here who's joining in to give us all of those details. Vinny?
Good morning, and absolutely, when you just look at how the performance has been for Mrs. Bector's in terms of the stock price, last 1 month, when you look at it, 21% gains in just the last 1 month. YTD performance, 81% gain in terms of the stock performance, much better than what we're seeing coming in terms of the street as well. YTD performance also more than 80% gains is what Mrs. Bector's has seen coming in. Now, just let's look at the breakdown in terms of the market that is happening, especially in terms of the biscuit market as well as the bread market, where biscuit market, Mrs. Bector's has around 60% in terms of the revenue comes from biscuit, while in terms of the bakery and bread market, 35% of the share is revenue, total share comes in from this segment. Now, biscuit segment, when you look at it also, most of it in terms of the organized market is 65% of the share is coming in from the organized market as of now. And in that comes Mrs. Bector's. Right now, they have a very small percent of share. When you look at it, it's just 1%. So there is an opportunity for growth over there as well. In terms of the bread market as well, 50% is organized, 50% is unorganized market. It's around 13,500 crore market. Mrs. Bector's has a very small percent of share in it, and so that is there, which gives an opportunity to furthermore grow as well. Let's not forget they have that contract manufacturing business as well, which accounts to mainly for the QSR segment of theirs, as well as where they give breads to and buns to Domino's as well as McDonald's are some of the names coming in there as well. Now, why the run-up that we've seen coming in, especially in Mrs. Bector's? What is the reason for this run-up already? Let's not forget, obviously, in terms of the strong guidance that the management has given, an outlook that the management has given for the next 2 years, especially in terms of the growth, as well as where they're expecting the growth to be in the high teens in both the bakery as well as the bread business as well. Margins also, they are expecting to 13 to 14% in the near term, and then gradually move towards the 15% mark as well. Doubling of distribution is what they've been focusing on. They have been increasing the distribution channel over the years and will focus more on that as well. In the biscuit segments, they've forayed into a lot of new markets coming in as well, especially when you look at it, something like a Mumbai, Pune, where they've already entered into, and they are focusing on entering into 10 new cities over the next couple of years as well. Next year, actually, to be precise, is what they're focusing on in the 10 new cities as well. Let's not forget, in terms of, aggressive capex plans that the company has, the company should be in terms of the 75 to 100 crores in terms of per annum in terms of capex over the next 2 years as well. Now, what could actually impact the run-up going forward? One, if the company sees anything in terms of the ability to ramp up their business in terms of distribution, that would be a worry. Inflationary trends, commodity prices go up, that could lead to a slowdown as well as the down trading coming in. While in terms of competitive intensity, that's a factor that one should watch out for as well, increasing competitive intensity in the premium and mid-premium segment. Valuation-wise, Mrs. Bector still is cheaper than other FMCG players. So will be interesting to see what path now Mrs. Bector's take.
Right, Vinny, we'll leave it at that. That's the lowdown coming in on Mrs. Bector. But here's some fundamental ideas. Hear it out from Pankaj Pandey from ICICIdirect.com as to why he likes NBFCs.
We are very selective in this real estate space, largely because one, the overall macro tailwinds are sort of turning better because we have seen 250 bips kind of a rate hike. So home loan rates have crossed 9% for most of us. I think that is sort of trending lower going forward with inflation not really sort of looking to sort of look higher. So that is one thing. And I think we are very selective in the space because what we like is something like Brigade Enterprises or Mahindra Life's space. I think largely because of their selective exposure in some markets. So, for example, we are still not comfortable recommending Oberoi. I think Thane launch is still sort of pending, and it's still into one particular market. So we are looking at companies, or we prefer companies which are there into multiple markets. So accordingly, I think Brigade Enterprises looks best because I think they have very little debt on the residential side, which is what ideally it should be. And Mahindra Life has been sort of meeting the targeted land acquisition targets. So from that perspective, these two companies are the top bets in the real estate space.
All right, let's bring on board then Chakri Lokpriya as well on the show to discuss the fundamentals as well as the outlook for the markets. Hi there, Chakri. Good to have you on board. Let's discuss the entire auto space because 4 straight sessions that we've seen that sector has been in the spotlight. How have you read into the pretty much healthy auto sales numbers that have come in, and do you believe that there is strong opportunity within the sector?
The auto sector has clearly done well, and as we've discussed in the past, and I think they'll continue to do well. The economy is still just recovering. It's So we're still in the early stages. It's still kind of some of the pre-pandemic growth levels are still not there. And some of it is still catch-up buying, which is happening. A combination of all this commercial vehicle sales are likely to pick up. So which means companies like Ashok Leyland, passenger vehicle, now that Maruti has some semblance of EVs, that looks good. And in two-wheelers, I think TVS Motors continues to look good, and M&M, of course, is a sum of parts story. So, which means the list is quite big, but they all look good.
Kunal, and fresh, renewed energy when it comes to autos, right? I mean, yesterday's price action in both M&M and Tata Motors was fabulous, even Maruti catching up.
Absolutely, yes, Aisha. So I think, we are not too much dependent on just the likes of, I think, M&M and Bajaj Auto, which had done pretty well. This time around, you have Eicher Motors, which have done reasonably well. I think Hero MotoCorp has also, very steadily and quietly, I think it's come back towards the previous major multi-month high for itself. Maruti's made a very strong comeback. I think it's closing in by just a couple of percentage points away from its lifetime high levels of 999 or just about that 10,000 mark for itself. M&M has made a very strong comeback. It's almost a V-shaped recovery for M&M from 1350 levels. The stock corrected to 1100 mark and now back above the 1350 mark. So, these are very strong indications that the entire auto sector is looking a lot more vibrant. But there are few stocks within the auto pack which are still looking a lot more sluggish. The likes of Ashok Leyland, for example, the stock has been absolutely sideways at 145.50 mark. So I think it always makes sense to bet on momentum. And I think at this point of time, Maruti, M&M, Tata Motors, these are the stocks which are riding on extremely high momentum.
Right. Chakri, just wanted to understand how much confidence would it give it back in the market, the fact that the Adani Group yesterday said that it has prepaid loans worth about $2.6 billion. The fact that in February, it is this episode with Hindenburg that actually rattled the markets. Do you think, much of the confidence and investor trust is now going to be back? In any case, the stocks have seen a massive recovery from the lows.
Indeed. I mean, if you look at Adani as a group and its various companies, whether it's Adani Ports or Adani Wilmar, naming a few, all of these are actually kind of an annuity kind of a cash flow business if you fast forward. Ports is a very steady state business. I mean, Adani is Ports is a growth company, but whenever the growth stabilizes, Ports income is a very annuity kind of business. Adani Wilmar, very similar story, very strong brand. So like that, so from that perspective, I think they have now matched their both growth aspirations, brought it down a little bit, accelerating their debt repayments. And therefore, I think the outlook, now is in a far better place than when this whole episode broke out a few months ago.
Okay, here's Godrej Consumer. That's also going to be in the limelight today. They've appointed a new CFO, and here's Vinny with all the details on him. Vinny?
Yes, we are seeing a new CFO who will be taking charge on August 10th, and that is going to be Asif Malbari, who will be taking over from Sameer Shah. Sameer Shah will be moving to a more group level role, and he will be taking and leading the consumer investment at a group level role. So yes, the new CFO will be Asif Malbari. Asif Malbari is currently with Tata Passenger Electric Mobility and a director at Tata Motors Passenger Vehicle Limited as well. Before that, this is about since 2018 he's been with the Tata Group, but before that he was with Hindustan Unilever, so he does have a fair idea of the consumption place as well. And obviously what analysts are saying, he's suitable person taking over as a CFO of the company. He's worked in many roles ranging from business partnering as well as buying, planning, logistics, controller, leadership, treasury as well as investment relationship as well. So yes, a lot of roles that he's taken place as well, and worked at Unilever itself as well before. So keeping an eye out on Godrej Consumers on the back of this news.
Okay, since we were talking about the auto space, there's Eicher Motors as well, which is going to be in focus. The management is expecting a double-digit growth in the next 2 to 3 years. And they're saying that the EV two-wheeler development is pretty much on track. There's also JK Cement. They've acquired the Shali Cements for 157 crore rupees. And then, of course, there's Delivery as well, which is going to be in focus. They've reiterated the long-term growth prospects. They're targeting an express parcel business margin in teens. And that's going to be another stock that we're going to be looking out for in a trade today. There's MTA Technologies as well, by the way, wherein the promoter entities have sold about 3.6% stake in the company via block deals. So these are a bunch of stocks which are going to be, interesting to keep on our radar this morning. But Chakri, any new stocks that you may have identified or have recommended or bought already?
In the financial services space, companies like Power Finance and REC, both of them look good. Here, the companies are trading at very low valuations at about less than half a time's adjusted book. Now,
we seem to have snapped that line with Chakri, but he was talking about as to why he likes PFC and REC. Kunal, interesting names. Anything unusual that you read on the charts for PFC, REC?
I think there's a lot of momentum which has come back again. So PFC, REC are the stocks which are historically very sluggish and very slow with their with their trends. But this time around, the momentum has been very sharp and very swift for these stocks. I think just about last week or so, PFC was trading at 180-82 mark, and I think yesterday the stock made a high of 196.98. So that's a good 10% move for a stock like PFC. That's generally what we typically don't tend to see for the stock in such a short period of time, and that tells you that the momentum is very high into these names. And traders who are riding on high momentum, they could probably benefit by cashing onto the stock. I think 185.88 would now be a fresh support for PFC. So keeping that as a stop loss, traders can still hold on to their long positions.
Right. Okay, Chakri is back with us. Chakri, you were making the point on why you think PFC, REC are good investment bets?
Yeah, indeed. Other than valuation, they have new avenues of growth. They're financing solar and other green types of financing as well as they're getting into infra financing in terms of, fiber net. And all these things are very new growth areas. The net NPS is only 1%. Valuations are on their side. So I think, both PFC and REC are looking good.
Okay, that's the take coming in on PFC, REC. Those are going to be a bunch of stocks which are going to be in focus this morning. We're also looking out for IEX, by the way, although this has been a great performer of a stock on a year-to-date basis. But their May overall volumes are up 8% and the prices have fallen a good 30%. Now standing at 4.74 rupees per unit, and these are the year-on-year stackable figures that I'm giving you. This year, the stock is appreciated about almost 9.5% or so. Yesterday, of course, the defense stocks were once again seeing renewed vigor. And Chakri, the big debate is whether or not these defense names have further legs to go, or you think they're going to consolidate for a while? And do you actually find value on the table to buy afresh into any of these names?
The stocks have done well, and I still think that they will continue to do well. And yesterday, with the news of that, US was open to providing some technology transfer supports to Indian companies, that is a huge, huge positive as and when that happens. And as it is, all these companies, whether it's Hindustan Aeronautics, Bharat Electronics, all the shipyard companies, they're sitting on very strong order books. So I think the outlook is still good fundamentally, even though they've done well.
Have it. That's the view coming in on defense, but there are other interesting names that we need to discuss in trade today, and that is the stocks on the editor's radar. We'll be flagging off Tata Motors DVR as well as what's going on within the entire consumption space. Let's begin, Nikunj, by just drawing a parallel between the performance of Tata Motors versus Tata Motors DVR, and what are the observations?
It's always been observed that DVR is trading cheap, and it is trading cheap. And, as individual investors, since you do not really care about the voting rights, DVR is always the best instrument to buy into. This year also, optically, the Tata Motors stock has done very well, and you tend to think that, okay, DVR is not doing that well. But just think about it. YTD return for Tata Motor DVR and for Tata Motors is actually neck to neck. Similarly, in last 1 year, the gap which actually was there between the Tata Motor DVR and Tata Motors actually has narrowed down. Well, the reason why I'm bringing it up is because Tata Motor DVR and Tata Motor stock, they both actually right now are the go-to stocks. The normal tendency is that you tend to think that DVR gives you a better entry point largely because it's trading at a discount and it has underperformed. Well, that's not the story. On a 5-year basis, there is underperformance, but in last 1 year, the discount actually has covered up. I, for one, think that while the DVR optically is a low denomination stock, but from an institutional investor standpoint, because Tata Motor stock is dominated by institutional investors, not retail and HNI investors, I think one is better off buying Tata Motors.
Okay.
It is better. Why? Because that's where the institutional interest normal would be there. Institutional investors do not want to buy DVR because they've got compliance and the other things which really kick in. So my limited point here is that this is how the Tata Motor DVR in last 52 weeks has moved. DVR has done much better than Tata Motors. And if you still want to buy Tata Motors, it's better to buy Tata Motors, the stock, rather than the DVR.
Okay, that's Tata Motors versus Tata Motors DVR, the preferred option. Let's move right on and talk about FMCG because the annual reports have trickled in, and clearly the word that seems to be highlighted is that there is a slowdown and it is volatile and it'll take time for things to recover.
Well, whether it's HUL and Tata Consumer, the annual reports, what we've looked at, they are pretty much admitting the obvious that the rural economy had hit their business last year and they do not expect a very meaningful recovery, at least in the first half of this year. That clearly means that urban FMCG companies will have a niche advantage. Companies which are moving really the premiumization basket, they will have an advantage. And companies which are focusing on new verticals and are adding new product to their pipeline, which is focusing on urban consumption or semi-rural, I think that will have an advantage. Most of the companies are also of the view that there is margin recovery for the international business and there is going to be strategic initiatives they would be taking. So I think the key takeaway, frankly, which is coming from a Tata Motor annual report and the HUL report is that consumer business will recover, but it will be urban focus. Worst of the margin, I think that compression is behind them, and new product category launches are going to be the driving factor going forward.
Okay, there you have it. That's the outlook coming in, Aisha, on Tata Consumer as well as HUL and the Tata Motors DVR.
Oh yeah, absolutely. And some more fundamental ideas this time around from Sandeep Sabharwal as to why he continues to bet on the defense sector, and here are the stocks that he likes.
Huge, long gestation period of most of their projects. So most of the analysts get excited when the order is announced, but they don't realize that designing process itself will take so long. The execution might start after 3 years and deliveries might be after 5 years for many of these projects which companies like these shipyards are doing, or also a company like Hindustan Aeronautics, etc. are doing. So I think investors need to keep that in mind before buying their stocks, not immediately extrapolate orders into profit projection. And longer term outlook for most of them still seems to be good, but then many of the stocks have run up so much that they seem to be priced for perfection. Among the best listed companies, I think Bharat Electronics came out with decent results. So I think that's something which we have also accumulated. And I would be positively inclined towards that because that's where there's some valuation comfort. In terms of the sheer positivity of growth outlook, Hindustan Aeronautics stands out because of the magnitude of orders they've been giving. So that's something one can accumulate on every dip.
Okay. I'm going to take a conversation forward in terms of where Tata Motors is headed. And Chakri, where do you think Tata Motors is headed?
Stock is headed much higher from the current levels. For well-known factors of one, they were one of the first companies, one of the large companies to announce a proper EV pipeline across various price points. Second, their traditional businesses have picked up. Third, their debt has come down. And now leading into their analyst meet sometime next week, where we will see further details on this roadmap. So I think now you'll value the company much higher because the debt profile is far better than it was before. So from that perspective, I think an easy 25% higher from current levels in a year from.
Okay, what one is seeing right now in the market is that incidentally, it's actually the broader markets which is outperforming the benchmarks. So while the Nifty is 1.6% away from that all-time high, the Nifty small cap is about 13.5% away. But the Nifty Mid-Cap 100 Index is already at an all-time high. So year to date, you've seen the Nifty Small Caps gain about almost 6.5%, and the Nifty Mid-Cap 100 Index has already gained about almost 8% or so. But Kunal, as a cluster, would you be restricted to, say, large cap names, or would you just go with the trend wherever there's buoyancy?
I think you have to go with the trend as well as mid-cap and arena at this point of time. So I look at this with that, whether the markets are more pessimistic or circumspect. In this case, the markets are into a very sweet zone where there is a mix of optimism. There is still a lot of left out feeling or FOMO effect for many market players. So in that in that phase, it's where the mid caps they would tend to outperform. I think small caps have done exceptionally well in 2020, 21, especially 21 second half. And I think that's one of the major reasons why the small cap index relatively is underperforming. But I believe that the outperformance of mid caps is something which is quite strong, because in 2020-21, when the mid cap index was going, all guns blazing, that was a time when the momentum was still very restricted. It was very, calibrated, but it was not too much of a extreme momentum for the mid cap index. And the fact that these indices have made a fresh high much prior to the benchmark index tells you that the momentum and the inclination is more towards the mid cap index. So you have to play with stock specific, sector specific. This is a phase where the large caps, most of the large cap names are actually not performing at par or as per the expectations of the benchmark index. So the tilt is more towards the mid caps as well as the performing sectors. I think one has to ride those momentum into these kind of spaces.
Okay. Suresh, Trent is another stock which has really been an outlier. It's an expensive stock, but it's a stock where the bull run really continues.
So the stock has been the biggest surprise, but what is interesting to note is just because we have been looking at Trent a lot more, I was just looking at a chart for Shoppers Stop. That stock is also just 2% to 4% away from an all-time high. So this clearly shows the leadership has been set. Trent has been there in the sector, which continues to do well, and the trend continues for it and continues to surprise on the upside. Similarly, there is a Shoppers Stop also, which has surprisingly come up. But it's just that these stocks are slow and steady names. They do not have a daily volatility wherein they are not up 6-8% on a daily basis. End up being in a slow and steady move. It does not come in a radar all the time. But the trend is clear. We have a leadership in terms of Trent and Shoppers Stop. The other names have actually lost way. ABFRL has gone through a 40-50% correction. The other names have not done as well. But clearly shows that the sector is in a strong uptrend. It's not just Trent as well as there is Shoppers Stop also in a very similar position. You want to be buying them on dips, not at current levels, because they've gone up a good 30% over the last couple of months.
BPCL and HPCL. Chakri, everything is going their way. Valuations, windfall taxes over, retail prices are strong, crude is down. Yet HPCL, BPCL are just not bouncing back.
Indeed, these are one of those enigmatic stocks because valuation is always on their side. I think there are two things markets are expecting. One, there may be a sharp oil price hike. I mean, oil prices globally may go up, in which case their margins go down for these companies. Or two, the prices. The companies are required to cut petrol and diesel prices at the petrol station as we run into elections. That's the other risk. So one of these two can happen, but that is probably what is holding back these stocks.
Okay, that's the take coming in on OMCs. Let's just take stock of what else has been moving in the market. And while, of course, autos have been in full gear, the banks as well are seeing a bit of a churn. And yesterday, if you look at how the banking pack fared, it was actually Axis and IndusInd Bank, along with, of course, ICICI Bank, which was actually taking the lead. Kunal, give your thoughts on Axis Bank and the way the stock moved yesterday. 2.5% up in the green is no mean feat.
Absolutely, Aisha. And I think I would look at Axis Bank in the last 1 or 2 months, because ICICI Bank has been struggling in this band of 900 to 950 quite decisively. But in that band, Axis Bank has moved up from 850 to now 930, 940, where it closed yesterday. So there has been decisive tilt of high performance into Axis Bank. Look at this way, even the likes of IndusInd Bank, I think, has managed to make a 3-year, 4-year swing high, breaking past, I think, about 2019 highs when the stock was at 1300 levels. So in the last 1 or 2 months, there has been a definite change as well as churn within the private sector banks. You're not, the market participants are not too much inclined towards the likes of HDFC Bank, Kotak Bank, because these stocks have grossly underperformed. But the momentum is shifting towards the tier 2 names, or if you can call them tier 2 names, the likes of Axis and IndusInd Bank. So I think IndusInd Bank ranks to be one of the better names because of the way the stock has confirmed the breakout and the setup the stock had shown in the fag end of 2022. Axis Bank is emerging as a strong breakout candidate, and hopefully we can see a renewed momentum. So I think both these stocks are looking far more better as compared to the traditional large cap private sector banking names.
Credit Suisse has come out with a note on capital goods, and they're saying for Concor, again, it's an underperform rating on Concor, ABB as well as Voltas. For Concor, they say that the weak exim cycle, losing market share, lack of any evidence of road to rail shift so far, and the lack of near-term visibility on disinvestment catalyst as well seems to be at play. For ABB, the concern, of course, is high valuations, pricing in the 20-year CAGR of less than 20% at 13% plus EBITDA margins. For Voltas, they say that the market share and margin losses have given leadership status in a segment with prevailing tough competition. Chakri, but cap goods, given the interlinkage to the entire overall manufacturing theme, just wanted to understand whether you also believe that in the near term these stocks could have topped out.
The names that you mentioned, I think ABB will continue to do well because this company, despite its high valuation, has a very strong product portfolio, access to its parent product portfolio, and companies which are high PE, which are able to deliver on growth, continue to remain high PEs for extended periods of time. So ABB looks good. On the other hand, Voltas has been, facing tough competition in the air conditioning space. There is no pricing power. All the companies are trying to take market share. Concor, I think, is a disinvestment story, but valuations, if you're a really patient investor, then Concor, yes, because disinvestment is a kind of unknown when it will happen, but valuations are on your side.
The other dark horse, Naresh, some would argue is IDBI Bank. At least that's one space where the disinvestment is moving in the right direction. In this entire banking rally, IDBI Bank frankly has not participated. Last 1 year change and the last 3-month change means it's an underperformer. But it's a stock, Naresh, which is dominated by China investors.
So this is a stock which could move only on a trigger. The stock has gone nowhere. We've seen all the spikes over the last couple of years come on trigger points, and say we've gone to 60 on this stock multiple times, 55, 60 levels, closer to 60 odd. It has made a top almost 4 times over the last 3 years. So I would be watching it out because the stock is back to 55. The only difference is now the stock has stayed around 55 for almost a month and a half. That is generally an indication that eventually it can break out. But I would wait for some more price action confirmation above 60 levels. But yes, the stock has finally come to a radar. It's a huge cup and handle formation, wherein that 60 on a sustainable basis, if it breaks, it could lead to a very surprising move on the upside. So yes, the stock is on radar, but the price confirmations are not there yet.
In the meantime, Chakri, just also wanted to get in your take on the entire telecom space as a whole, with the latest report coming in from CLSA that both Reliance Jio and Bharti Airtel are well placed to play the rising mobile data usage and penetration. How are you looking at telecom?
In the case of telecom, again, in the case of Bharti, I think the big expectation is they will take market share. Now, whether they in a two-player market, in a sense, one taking market share from the other is not really the story, I think, because I think it's just an expanding market share with 5G as and when that happens. So more importantly, the stock has done well, but still they're not able to get their ARPUs at a desired level of ARPUs. So I think, it's done well, so I wouldn't really chase it at this point. That is Airtel I'm talking about.
Chakri, good to have you on board. Thanks so much for taking time out and joining in. All right, let's shift gears then and find out what the top mid-cap calls are from our charters as of now, looking at a pretty healthy pre-open rate on the Sensex and the Nifty at 18,650 plus levels. Let's find out, Naresh, what is it that you're picking out within the mid-caps?
So that would be a buy on Tata Power. The stock has started making higher tops and higher bottoms. Has gone through a decent enough time correction. The stock had peaked out in September of 21 to April of 2022, around that 260 to 280 mark, corrected all the way down to 190s. Gave a false breakdown also around that 190-95 area. The last 4-5 month highs were crossed around that 210. Did a retest of those levels and now slowly and steadily has started making higher tops and higher bottoms. Yesterday gave a small pennant breakout. So the trend seems to be set here, keeping a stop loss at 212 and a target price of 240.
Okay, let's find out what Kunal's mid-cap call is as well. Kunal?
So I'm betting on another private sector banking name, albeit a smaller one. So that's a buy on RBL Bank, trading at 170 to 73 levels. It's confirmed a double bottom pattern breakout for itself. Momentum has come back again into the stock. In fact, in the last 1 or 2 weeks, the stock has risen from 145 to 175 approximately. So that's a steep rise of 20% for RBL Bank. That's a sign of a very strong momentum coming back into the stock. Would bet on it for a target of 188, stop loss at 165.
Okay, there you have it. Tata Power, RBL Bank, your top mid-cap calls. Let's move right on, and here are some of the other headlines that we're tracking. The US Security and Exchange Commission has sued the world's largest crypto exchange, Binance, and its billionaire founder. Allegations of failing to restrict US consumers from its platform, misleading investors about surveillance controls have been slapped on the company. In a reaction, Bitcoin prices have declined to 3-month lows. Meantime, the former Vice President Mike Pence has filed papers to join the race for president. Pence is expected to personally launch his campaign with a video speech and a town hall event. The move pits him against Donald Trump, the man he served in the White House for 4 years from 2017 to 21. Meantime, audio streaming giant Spotify has decided to lay off 200 employees from the podcast division. Cuts were announced by the vice president over a memo which said generous severance packages will be offered to those who've been impacted. This is about 2% of their worldwide workforce. Spotify recently has spent heavily to expand their podcast unit in the last 3 years. Meantime, the Wadia Group-owned airline Go First has sought approval to restart flights with 22 planes for the next 5 months, according to the ET reports. The DGCA had asked for a resumption plan after meeting with the cash-strapped carrier just last week. And the IMD has predicted heavy rains for Mumbai and the Konkan regions due to intensifying low pressure in the Arabian Sea. The low pressure is expected to intensify into a depression by Friday, and the IMD has said that isolated heavy rains will be seen in Mumbai and the Konkan regions by the weekend. And to the world of sport, in football, AC Milan striker Ibrahimovic has announced retirement in football. This announcement surprised fans following the AC Milan's 3-1 victory over Verona on Sunday. It is a moment to say goodbye, and the 41-year-old striker is bidding goodbye to the San Siro pitch. And the much-awaited World Test Championship final is a day away. India is going to face Australia at the Pavilion in England. India is looking good with its top-order batting lineup. It includes Shubham Gill as well as Virat Kohli, which have shown very good form in the other formats so far. Lots lined up today on the show, but let's put the spotlight then on the cover on D Street. API companies, they're in focus on the back of channel checks, which suggests that the industry is seeing 30 to 40% cut in the prices of key raw materials. Why is this happening? What does this mean for the API companies? Let's get in Sharad, who joins in with the details. Sharad?
Well, yes, in focus we are having the API companies, and what we are gathering from the channel checks is the price of the important key raw materials have actually fallen between 30 to 40%. Now, this is across the key therapies, and these include the bigger names of the key APIs as well as solvents. Now, it's expected that the raw material prices are expected to correct going ahead in the month of June as well. Now, the overall immediate impact would be, of course, the improvement seen in the gross margins. But what has led to the reduction of these prices, that is something to ponder upon. The first thing is the production from the Chinese plants that has stabilized, and of course the government linked PLI schemes which have come in India have actually ensured that the supply remains strong. Now overall, of course, if you look at the lead time for the containers from China, that was at the peak levels of 75 days during COVID, and now that has come down to almost 20 odd days. Now the impact, what the impact means, especially for the API companies, expected to have an immediate benefit at least in the first half of FY24. The margins are expected to go up, while for the formulations company there is a kind of a lag, and that is why the second half of FY24 would be fruitful for them. But what are the key companies which would be there in focus? And these names include Solara, Granules India, Aarti Drugs, Newland Labs, Glenmark Life Science, and also IOL Chemicals.
Thanks very much, Sharad, for giving us those details. We'll be watching out for some of these API-linked stocks. Moving right on, let's hear out the editor's take. FMCG companies, the likes of HUL, Tata Consumer, they've come out with their annual reports. They're talking about volatility in the near term and the risk of a slowdown. What should you do with these stocks? How should you approach the FMCG space as a whole? Let's hear it out from Nikunj.
Whether it's HUL and Tata Consumer, the annual reports, what we've looked at, they are pretty much admitting the obvious, that the rural economy had hit their business last year, and they do not expect a very meaningful recovery, at least in the first half of this year. That clearly means that urban FMCG companies will have a niche advantage. Companies which are moving really the premiumization basket, they will have an advantage. And companies which are focusing on new verticals and are adding new product to their pipeline, which is focusing on urban consumption or semi-rural, I think that will have an advantage. Most of the companies are also of the view that there is margin recovery for the international business, and there is going to be strategic initiatives they would be taking. So I think the key takeaway, frankly, which is coming from a Tata Motor annual report and the HUL report, is that consumer business will recover, but it will be urban focus. Worst of the margin, I think that compression is behind them, and new product category launches are going to be the driving factor going forward.
All right, let's move on. Index calls then for the day. What is it that our chartists are advocating? 18,600 is the print on the pre-open rates right now. A hold call seems to be the way to go, though Kunal sticking his neck out. He says buy on the index this morning. Let's find out. And of course, the moodometer tilting in favor of majority. It seems to be a consensus hold recommendation. A quick check-in on what the advice is on the Nifty Bank and ditto. Kunal saying buy, but Kush as well as Naresh believe that it's a hold recommendation on the Nifty Bank index. So that's the hold call on the Nifty and on the Nifty Bank.